Hey guys, welcome back. In today's video, I just wanted to roll out a call. I'm going to walk you through how to do that. For this call, I'm going to use my Marathon, or Mara is the ticker. It's a company that mines on the blockchain. They mine cryptocurrency, so it's a really volatile stock. But I have 100 shares at $34. And I sold a call for $42, which you can see it expires today, and it's staying above $42 even at its lows. So pretty sure it's going to be assigned, which isn't a bad thing. I would make a good amount of money, but I do want to keep these shares. So I think I'm just going to roll this call out to next week at a higher strike, make more premium, and I just wanted to do the math, show you how that's going to work out. So I did this already. My 100 shares, $34, so that's $3,400 right there. Previous calls and puts that I sold before this, I have made $614 in premiums, so that's what this 614 is. So if I minus that from my cost, my true average cost is $2,786, which is $27.86. So to close this call, what I'm going to do is look at my return here. If we pull open my call, you can see I made $52 when I sold this call, and now the current value is $186. So that means I am down 134 at this time. So if I close this, I'm down 134. Open my options chain and look at selling a new call. I think I would like to stay around this 47 to 48. I think 75% chance. I think I'll go with this 47. So that's 261. So that comes to $127 of profit if I close and sell this call. What I like to do is get at least 2% in premium per week. So 2% in premium of my cost. You know, I put 34 in, got 600 back in premiums. So my cost that I have tied up in Mara right now is $27.86. So $127 divided by 2,786 gets me a 4.5% return for that week. So that's pretty good. This stock is extremely volatile, so these premiums are awesome. So that really helps here. But so I'm going to look at the chart here. One other note is it's always best to buy to close an option at the bottom of the chart. So when it's down, if I can buy down here and then sell a new one after it's came up, it's small amount of difference. But in a stock like this with the volatility, I mean, if I could buy to close down here and then sell a call up here, I mean, that could be a difference of like 20, 30, 40 bucks at least. So it can make a pretty good difference just, you know, buying to close it when it's down and then hopefully selling a new call when it's up. It's kind of a risk. Time in the market is obviously very hard to do. It's more luck than anything because nobody knows what it's going to do, but we are down pretty good. So I'm going to go ahead and buy to close this option. So I just make sure that I am on today's expiration because that's the expiration from when I sold the call. Buy call, my only option because it expires soon, is the one I have open. Select this one. With the stock price going down, I'm going to try this. I'm going to change it to 160. And so here it just says you're paying $160 to buy back one open contract, which will release collateral and remove your obligation to sell 100 shares. So I'm just buying to close. It releases my collateral. I get my shares back. And it will cost me $160. So I submit that. Oh, and it's filled instantly. I'm just going to write that down. It cost me $158, but I had made 52 when I did that, so my actual loss there would be $106 instead of 134. So I'm down $106 the way that worked out. Now if I wait a little bit and have this come back up before I sell a call. We'll see what that looks like. I'm gonna check out the chain right here. We're at 43.45. I go to March 26th and I'm going to sell a call now. And I'm looking at that $47 call and we're at $257. I could probably get it filled for $260 right now. But I'm going to wait and see if that will increase. Because if that stock price, if the share price goes up and gets, say, around 44 or even over 44, then I'd be looking at probably closer to like 280. So I mean, about a $20 to $30 difference here if I just wait a few minutes. And so I will be back in about 5 minutes. We'll see what this price looks like. Alrighty, it has been about 7 minutes. And you can see the price has gone up some here. Don't know how much higher it's going to go. It's actually just dropped back down, but I did buy to close down here. I'll sell a little higher. That's pretty good. It's not a big deal and it's not huge if you do that. I just like to try to buy low, sell high, you know. So we'll pull back open the options chain. All right, so we're at 262. I'm going to select that one for March 26th, selling a new call, one contract. I think I'll just do 265 here. Should get assigned pretty easily. That'll give me $265. And yep, it's assigned immediately. So that is good. I got a new call. So just do the math on that real fast. I got paid $52 on my call that I had open. I closed it by paying $158. So that means I am down $106. But for this call that I just sold, I collected $265. You can see that right there. Do that here, 265 minus my 106 means my new profit is 159 in premium. So 159 divided by my 2,786 means I got a 5.7% return in premium for 1 week's time. Because this is a 1 week option, I got 5.7% return on the money I have tied up in Mara. So pretty good return there. Like I said, 2% is good with me. If this shot up and I got assigned at $47, then I would mean that's just even more profit here. So I would be completely happy with that. If it doesn't, I keep increasing my premium. So, and I'll do this math too. I was at 614 before I closed, paid 158 to close. So that put me to 456, and then I recollected 265 when I sold a new call, and so that gets me to 721 now. So this is how much premium I have collected, and you can see the benefit of rolling this call out. I keep my shares, I make more premium. If it would have expired worthless and then I sold a new call Monday, obviously that would be even more, but I just don't really have a choice with the stock being up 5% today. So yeah, I just thought I'd go over that. That would, I guess let's do that real fast. My new average cost, now that's no longer applies, would be the 3,400 minus 721. Makes my new average cost $26.79. So that's what it is right now. If by next Friday this $47 call expires worthless, then I mean that's my average cost, and I'll just keep it going. I can slowly over time, just week by week, lower this average cost and increase my profits. Hope that helps clear things up and demonstrates how to roll out a call. Any questions, let me know in the Discord. Thanks for watching.